How would you like to be able to identify high probability trade setups without having to sit in front of your charts for hours? I hope I sounded like a real YouTuber just then, but anyway, man, welcome back to the channel. Today I'm going to go over with you another one of Stacey Burke's best trade setups, all right? And I'm going to try to keep this as to the point as possible because I have a feeling it's going to be a long one, okay? There's a lot of details that are going to be added into this video, okay? So this trade setup that we're going to be going over is known as the low-hanging fruit trade. Just like the name, this trade setup, the low-hanging fruit trade, is just like a ripe fruit that's hanging at the bottom of the fruit tree. Easy for you to grab a hold of, pluck off, and take a bite of, right? The low-hanging fruit trade, really what this is saying is take a look at this chart. You can see that small green box, that's the New York Open, okay? So the move has already started. You can see where we have that high to the left, and then the market starts to break down, and then we break out of this consolidation. So the move has already started, but when we come to the New York session, there's still some juice left in the tank, and we get the opportunity of entry, right? This slide, I want you to refer back to this slide. If at any point in the future you start to feel confused, frustrated, lost, whatever, come back to this slide because this is the low-hanging fruit trade with the details stripped away. To keep it simple, this trade setup, right, we're looking for a market in consolidation, a coiled market. We're waiting patiently for the breakout, pullback, trend trade. According to Stacey, the market only does three things. It breaks out, pulls back, trends, breakout, pullback, reversal, breakout, pullback, enter a trading range. So in this case, we have a breakout, pullback, trend trade. Okay, this is a simple continuation trade in line with the trend, okay? That's as simple as it gets. That's the basic sort of template that we're looking at, okay? A continuation trade in the New York session. On this chart, we're looking at the last week, the week that just passed on the euro-dollar currency pair, okay? I've drawn this out simply for you again. Breakout, pullback, trend, all right? And you can see in parentheses, I put the word pump and dump because Stacey says that every trade, every setup really is one of two things, a pump and dump or a dump and pump. And I'm going to show you how to identify the pump and dump and all of that good stuff, okay? But I just want you to see this basic outline, the breakout, pullback, trend trade, all right? Now, I've outlined the day count. You can see we have day 1, day 2, day 3, Wednesday, Thursday, Friday, respectively, okay? That is the static weekly day count that never changes. As far as this day count is concerned, remember this. The first half of the week, so Monday, Tuesday, Wednesday, is day 1, 2, and 3. Wednesday is the middle of the week, and that starts the back half of the week. And Stacey says the front side and back side of the week. So on the back side of the week, we have Wednesday as day 1, Thursday, day 2, Friday, day 3. And that day count never changes, right? It's the same every single week. However, there's another day count that could possibly be going on simultaneously, which is a 3-day setup day count. And a 3-day setup that day count, that could consist of any 3 days of the week. So it doesn't have to be Wednesday, Thursday, Friday, but it just so happens that on this week, we have a 3-day setup that perfectly aligns with the weekly template day count. The way that we identify if we have a day 3 opportunity when we come to our screens is this. Let's say we come to our screen on Friday. We are going to look back at the previous 2 days, so Wednesday and Thursday, and we're going to use those days to figure out if we have a day 1, day 2, day 3, all right? So if you look at Wednesday, it's pretty obvious. We broke out of Tuesday's low of the day level, right? We break out of that level, we fall, we pull back, okay? So we start putting in lower lows, lower high, lower low, lower high, lower low, and that's the breakout leg that we have illustrated here, okay? So when that market breaks out of a daily boundary, okay, when Wednesday breaks out of Tuesday's low of the day, that starts the day count for a 3-day setup, a possible 3-day setup. Wednesday is day 1. Now on Thursday, we have an inside day, which means that the entirety of Thursday's price action takes place within the high and low range of Wednesday. Or in simpler terms, Thursday is a day that does not break a daily boundary. Thursday does not break out of Wednesday's low, and it does not break out of Wednesday's high. It's an inside day. Okay? I hope that makes sense. Inside days, according to Stacey, are trigger days, meaning we could look for potential trade setups in our session the next day. So we do indeed have a day 1, Wednesday, day 2, Thursday with the inside day, potential day 3 setup on Friday according to the 3-day setup day count. And that aligns with our regular standard weekly day count. Now you can see here in parentheses I put pump and dump, and I'm going to show you how to identify the pump and dump, but I also put the letters A and D, so pump and dump. The A and D, I just do that because I think it's funny. I think it's cool, okay, because it's called a pump and dump, and each letter of the word and, A and D, to me represent 3 pushes back into the high, right? Stacey's real big about this 3-push pattern, okay? We want to see a 3-push pattern back into the high, a 3-push pattern into the low before a reversal most of the time. So I do that. Stacey doesn't do that. That maybe it just gives me a little extra confidence when I see that 3-peak formation. I don't know what it is, but I like to do it. All right, so here I want you to notice Thursday. I've put that big black trend line with the caption, break of structure on the inside. Higher high set up for the pump and dump. Okay, you see that above that higher high on the inside, set up for the pump and dump. Stacey's always saying this, bro. And when I was new to the channel, it always confused the hell out of me. I was like, what is he talking about? I just couldn't understand it. So I'm going to break it down for you here so you can see the break of structure on the inside. This is the setup for the pump and dump, all right? So look at Wednesday's price action. And I'll remind you that we break out of Tuesday's low of the day, okay? The market totally collapses, and then it starts to trade up and down there near the low of the day, right? We get a lower low, lower high, lower low, lower high, lower low, and then another lower high before Wednesday closes, right? And then on Thursday itself is putting in higher highs on that day, right? But as soon as Thursday breaks above those lower highs from Wednesday, That's our break in structure on the inside. And why that's important is because when we break structure on the inside, even though we haven't broken structure on the outside, meaning we haven't broken a daily level, we still have broken structure on the inside, which triggers in other time frame traders. Okay? Those may be 4-hourly traders, right? 4-hour traders, hourly traders. And if they're triggered in, then every other time frame that's lower than that is triggered in logically, right? So this is potentially, we've got other time frame traders triggered into this market. We could be expecting potential big moves when this trade does decide to go, right? All right, so this slide is showing you what your charts would have looked like when you came to your screens at 9 o'clock New York time on Friday morning. All right? And we're inspecting price to see what we think is going on today. You can see I marked off the most recent high and most recent low that just so happened to be there on Thursday, okay? That high has not been broken, and that low has not been broken. That doesn't happen until we come to our charts. You see, right there around the 8 o'clock, 8:30 hour, price breaks out of the most recent low area that I have marked, right, for the first time, and gives a very distinguishable breakout close, okay? One thing you need to know about Stacey Burke's system is that Stacey is looking for coiled markets, right? A market that's coiled is setting up for an explosive move, okay, out of that coil. Another way to say coil is consolidation or trading range or sideways price movement, which is exactly what we have on Friday. We have sideways price movement between that most recent high and most recent low that I have marked off. This gives us what Stacey always calls a geometrical rectangle, okay? Classical charting principles. This is our high and low range that we are going to use with our custom fib tool, which isn't really a fib tool anymore. It's a range expansion tool. Stacey needs his own tool on TradingView, bro. But it's called a range expansion tool, and essentially all you do is go into the settings of your Fibonacci retracement tool and deselect, unselect every number, every percentage that it has selected except for whole numbers. So the number 1, the number 2, the number 3, keep those. That's 100%, 200%, 300%. Okay? That's what you want. So we're going to project these range expansions onto the market, and that's going to give us potential targets, okay? Potential profit targets. For me, I don't stick strictly to those. I use those as guides to help me, right? You understand what I'm saying? To help me establish where I may exit or if I might need to exit around this level depending on what's going on. But that's why this is important, right? This is a coiled market. Stacey looks for coiled markets that set up over 3 days or 2 days or 3 sessions, 2 sessions. And that's what we have on Friday. We have a market that is coiling over the course of 3 sessions. It breaks out during the 3rd session, at the 3rd session, New York Open. Okay? That's very important. Now, another thing that you need to notice about this is right where it says most recent low, on the second E of the word recent, it looks like price sort of breaks out right there to the downside, okay? And a lot of people would mistakenly call this a false breakout because it breaks out and then pulls right back up into the range immediately. They would call that a false breakout. We're not going to do that. We're not going to make that mistake. This is not a false breakout. What this is called a range expansion on the downside. And there's a quote, Stacey's always quoting it. I can't remember who said it, but it goes something like this. When you see a range expansion, the market is giving you a clear signal that it wants to continue in the direction of that expansion. All right? So that is a range expansion. Technically, we could have redrawn our most recent low and used that range when we project our range expansion tool to gain potential targets. But that's what I want you to see with this slide. That is the consolidation. That is the geometrical rectangle that Stacey is looking for. So with this slide, all I've done is highlight that range, that most recent high, most recent low, to show you that rectangle, that consolidation. And you can see there on the left, that is the range expansion tool where it says 100%, 200%. And I'm going to use that as a guide to help me with my exit strategy. If I need that guidance, that's another form that's going to help me out. So here we're taking a quick look at the New York session, that green box, right? That's 8:30 to 11 a.m. There's the trading range in the top left. You can see we break out of that trading range. Then we have a pump and dump that takes place over the course of the session. If you zoom in, you'll see a blue trend line that says higher high on the inside. Right there at the top of that pump, at the top of the pullback, okay, we have a break of structure on the inside when we break above that lower high to the left. Okay, that's a break of structure triggering in other time frame traders. We're on a 1 minute chart, so this triggers in perhaps hourly traders, 30-minute traders, 15-minute time frame traders, everyone's in the market, and we have other time frame traders that have been triggered into the market. This is just, gathering more liquidity or whatever. People are buying into this, thinking, okay, that was a false breakout. Okay, they're still on the idea, false breakout to the downside. They're buying that up. Okay, trying to predict price and stuff like this. But here, just a simple overview. We have the pump and here is our M formation at the 9:30 time frame. Like in real life, the time of day 9:30 is when we get this pattern. And remember that this M formation on a lower time frame, like the 1 minute here, on a higher time frame is an engulfment, which signifies or is evidence of traders trapped on the wrong side of this trade. Where does price pull back to, right? It pulls right back to the original breakout of that consolidation, puts in an M formation. We have the higher high on the inside, a break of structure on the inside, right? I just need you to notice this: timings, levels, behavior of price. The levels, it can get a little confusing because we're not at, a daily high or a daily low, but we are at a significant level. Now that we have this break in structure on the inside, we're at a significant level, okay? And we've traded back to the original breakout level. So we've traded back to the consolidation. Remember the first slide, it's just a simple breakout, pullback, continuation trade. So here's a quick look at the entry opportunities in the session. And first, I just want to point out, you can see here, right, that the move basically has already started before the session begins. And then we get these opportunities for entry. And that, my friends, is essentially the low-hanging fruit trade. You can see our first entry. It says first entry on bearish engulfment. So that last leg of that M formation, right? We have bearish candles that engulf the last high bullish candles, right? And it gives us our engulfment. It gives us that M formation. That's our entry. Right back there at the origin point of the breakout of that consolidation, okay? And we enter that trade. We get about 40 minutes of straight drop, right? And you could exit there, but personally, knowing this trade setup, knowing that we're coming from the high of the week, high of the day, we're aiming for the opposite side of the range, knowing that we have other time frame traders potentially driving this market, we're headed to the extreme, okay? So that's why I'm lined up there. You can see on the left, we have our range expansion tool there as a guide, but I'm targeting the low of the day from Thursday, okay? We also have a second opportunity for entry right around the 11 o'clock hour, or this is a potential opportunity to add into your original position. You could be adding into this the entire way down, all right? Now, I have some homework for you. That 11 o'clock entry, that is a smaller version of a pump and dump, okay? Price pumps up into the 11 o'clock hour and then begins to drop. If this is a pump and dump, right, there should be a break-in structure on the inside. We should see higher highs on the inside. Your homework is to go zoom into your chart and identify where we get that break of structure on the inside. The higher highs on the inside set up for the pump and dump. That's going to be very helpful and important to you in the future with your trading, right? So this is the low-hanging fruit setup. I know that we went through a lot of information tonight with this video. I hope it wasn't too confusing. I tried my best to keep this as simple as possible, right? But I hope that you liked the video. I hope you got something out of it. Until next time, man, I hope you continue to free your mind.